In this lecture, we are going to look at forms of business organizations. The objectives to be addressed include we getting a proper understanding of the laws regulating businesses in Ghana. And the forms of business organizations normally fall under various sectors. So we'll be looking at the private sector. That really will be our main concern because most of you will actually be setting up businesses in the private sector. So we'll be finding out if you choose to operate at the private sector, what are the various forms of businesses that will be available to you. Then we have the public sector, that is largely companies or organizations that are owned and managed by government. Then we will have the public-private partnership, where private individuals come into some form of agreement or partnership with the government to undertake a particular venture. Then more importantly, we'll be looking at the reasons why it is important to choose the right form of business. And as I indicated earlier, we'll be focusing more on the private sector. Why do you have to be careful in choosing one form of business over the other? So first and foremost, we have to know that whichever form that we pick and in whichever sector that we choose to operate from in terms of the business that we want to operate, there are laws, there are regulations that govern these forms of businesses and the sectors that we may choose to operate in. Okay, so the Registered General's Department is the government agency responsible for registration and regulation of business entities, except statutory corporations. So if you want to operate a business, you must have something to do or some business with the Registrar General's Department in order for them to assist you to be able to register your business. So we have these laws in Ghana that regulate the various forms of businesses that we'll be looking at very soon. So we have the Companies Act 2019, Act 992, which used to be Companies Act 1979 or so, but it has been reviewed. So the current act is 2019 Act 992. Then we have so from the name, obviously, it is an act that regulates the activities of companies. Then we have the Incorporated Private Partnership Act 1962, Act 152. And also from the name, it is a law that regulates the activities of partnership forms of businesses. Then we have Statutory Corporation Act 1964, Act 232. Obviously, it is meant for the public sector where statutory corporations and entities are regulated. Then we have the Registration of Business Names Act 1962. This also is for the private sector. Whether you are you want to operate a sole proprietorship, a partnership, or a company, most of the time you may want to have your name registered, and this is the act that regulates that. So as I indicated, our discussion will focus a lot on the private sector. So this sector refers to the part of the economy that is established and administered by individuals and companies for the purpose of maximizing profit. All right, unlike the public sector where you have government institutions and organizations running, most of the time their motive is just to provide some form of public service. And if they are able to break even, they find it to be okay. But if you operate in the private sector, most of the time, the motive for operating the private sector is to make profit. So we have these forms of companies. So if you finally decide to set up your company, most of the time it will take one of these forms. So you may either opt for sole proprietorship, you may choose to go with partnership, or you may want to set up a company. So we have the forms under private sector being sole proprietorship, partnership, and companies. What then is sole proprietorship? So it is a form of business set up, managed and controlled by the owner. All right. It is the oldest form and most popular type of business. It is sometimes called one-man business. So with sole proprietorship, as you just read, it is this type of business where you just have one person being the owner. He creates the business, he takes major decisions, he manages or she manages the business for its day-to-day activities. Okay. All the major decisions are normally undertaken by the owner of the business. It's coming from the word so, meaning that one or single person owning the type of business. All right. So as you might be looking at later, this type of business has its own advantages and disadvantages. But first and foremost, let's look at the features of sole proprietorship. So business income is treated as the proprietor's personal income. That's the first step. So there is no distinction between the income that is coming to the business and the proprietor's personal income. There is no separation. Very soon we'll see a form of business where the ownership is distinct or separate from the business itself. But when it comes to sole proprietorship, every income that is made by the business is as though the income is being made by the proprietor or the owner of that particular business. All right. The second feature is that the owner manages and controls the business. So from the definition, it is sole proprietorship. The person who created the business also manages the business and controls the activities of the business. The other feature we have to pay attention to is that sole proprietors have unlimited liability. Okay, what does that mean? It means that in a case of any form of loss or liability, the owner's personal assets and property can be sold to defray the liabilities and debts of that particular business. Okay, so there is unlimited liability. Once the business is at loss, all of the assets of the business is sold. The personal assets and property of the sole proprietor as well can be sold in order to settle the liabilities of that particular company. Because as we indicated much earlier, the business income is almost the same as the personal income of the proprietor. So if there is liability, then the liability of the business is just is the same as the liability of the proprietor or the owner of the business. All right. Point 4 is that they tend to have inadequate capital. And I think the reason is obvious because it's normally owned and managed by just one person. This person normally will have limited amount of capital available. Okay, so if you even compare that to just partnership, it's better to have 2 or more people coming together. They are likely to be able to contribute more capital in running the business than where you just have one person setting up a business. But the reason why these types of businesses tends to have inadequate capital goes beyond just the contribution of the owners of the business. All right. The other thing is that they are more likely to find it difficult to be able to secure loans and other financial assistance from financial institutions. Why? Because their size tends to be small, and so that makes it difficult for them to be able to meet the collateral requirements of financial institutions. Okay. And beyond the size, most of these sole proprietors don't also invest in keeping proper financial records and statements. And having proper financial records is one of the requirements that you need if you're going to a bank or any financial institution to seek for loan or funding. Right? Because of the size, because of their inability to keep proper financial statements, that also explains why most of the time they will have inadequate capital when operating a sole proprietorship. All right. Then the last point, we've touched on this already, decisions are made by the owner. Okay, so most of the time when the business is a sole proprietorship, almost all the decisions are likely to be made by the owner of the business. Okay. What are the advantages of sole proprietorship? the first point is that the owner or owners receives all profits. Okay, so it is not a partnership. It's just one person who has set up the business. And so the person who sets up the business, the business turns out to be profitable. The person who set up the business enjoys all the profits that comes from the business. Okay, then that will explain point two. There will be high level of enthusiasm because the person naturally will be enjoying all the profits of the business. There is the natural tendency for the person to exert a lot more energy when working in that particular business, because ultimately, if the business succeeds and makes more profit, it is the owner or the person that set up the business that will enjoy all the profit. So there is high level of enthusiasm. All right. So compared with that with, say, partnership, where when you make the profit, you are likely to be sharing the profit with other people. If even there is a loss, you don't tend to bear all of the loss. So that in that context, the zeal to really work hard is likely to be low compared with where you run all the risks and you enjoy all the benefits that will come if the business should succeed. Okay. Point three is that sole proprietorship type of businesses are easy to set up. Okay. So with companies, there are all manner of regulations, forms, and standards that must be met before these businesses are formed. That is a company. But when it comes to sole proprietorship, it's quite very easy to set it up. All right. Fewer regulations are required, as we can see in point 4 as well, to set up this type of business. That the regulations most of the time also goes with cost. Okay, so getting the forms, paying various kinds of fees, all of that will be eliminated if you opt to operate a sole proprietorship form of business. Point 5 is that decisions are reached and effected quickly. Because it's normally one person who runs the affairs of the business, they don't have to really struggle in decision making. If there's partnership, you'll need the consent of the other partners in order to be able to reach a decision. And not just reaching the decision, in order to effect or implement that decision, you need to deliberate and come to some form of agreement before that can be done. But with sole proprietorship, it's just one person. And so whatever he decides to do, he or she can just go ahead and do that. All right. The 6th point is that there is no corporate tax payment. So the business, the income of the business is no different from that of the personal income of the sole proprietor. All right. And corporate tax is a tax that is meant for corporations or companies. So once there is no distinction, what happens is that the proprietor will only be required to pay his or her personal tax, but the business itself is not taxed. So there is no corporate tax payment when you operate in sole proprietorship. Okay, but the income of the business will be treated as the income of the sole proprietor. And so personal tax will be applied to all of the income that will be coming to the sole proprietor. Okay, it's an advantage here because most of the time the tax rates are the same. The corporate tax rates tends to be higher than personal income tax rate. Okay, so if you're operating a sole proprietorship, most of the time you will be paying personal tax rate instead of the corporate tax that bigger corporations or entities will be paying. All right. Then the last point is you enjoy independence and privacy if you choose the path of sole proprietorship. So if you choose to set up a business all alone, not going into forming partnership or going to set up a company, then you can enjoy some form of independence and privacy. Companies by law are supposed to prepare and publish their financial statements annually. Okay, and these financial statements are also subject to audit by reputable audit firms. What it means is that if you set up a company, the details of your financials and most of your operations are supposed to be public knowledge, especially so if it's a public company. Okay, they are required to publish this financial statement. That is not the case of sole proprietorship. If you are a sole proprietor, probably it's only the tax authorities that will be interested in knowing how much profit you have earned for the purposes of taxation, as we explained much earlier on. But the public shouldn't know the details of your business. Okay, and that is also an important advantage for sole proprietorship. But there are also disadvantages of sole proprietorship, and we have to take note of this point. Very, very important. Point one is limited capital. All right. So much earlier we said it's easy to set up, and because really when it comes to the regulations that you have to meet, the forms that you have to fill is quite easy. Okay. But then when it comes to raising of capital, there is a problem. First, it's just one person. And so all of the capital will be limited to the funding that the sole proprietor can provide. As I explained much earlier also, sole proprietorship, because of the limited capital, tends to be smaller size companies. They don't normally have assets that can be used as collateral to go for funds from financial institutions. Financial institutions are skeptical giving loans to sole proprietors because, as we will see much later, the security associated with that is quite low. The death of the owner of this business could spell the doom of that particular business. Okay. The other point I explained much earlier is that sole proprietorship, because they don't have to really publish any accounts for the public or investing public to know what is going on. Normally, there is a disincentive for them to keep proper financial statements. And once that is the case, then it becomes difficult for them to secure funding from financial institutions. So if you choose the path of sole proprietorship, this is one of the challenges you'll be facing will be that you'll be limited to just a small amount of capital. All right. Then the second important point that you have to note if you choose to be a sole proprietor is unlimited liability. Right? If it is a company, your liability will just be limited to the amount of shares that you've contributed to or invested in the company. But if it is a sole proprietorship, there is no distinction between the debt or liability of the company and that of the owner. So if they were to sell all of the assets of the business, and that cannot help in paying the liabilities of the business, your personal assets and property can be attached, okay, or can be sold in order to defray the liabilities of the company. That is very, very risky, and that is very, very dangerous. So it's very, very important to pay attention to these points and deciding on which form of business organization that you want to go into. All right. You might be making all the profit if you go the way of sole proprietorship, but also bear in mind that you also bear all the liability if there's any form of debt that the company can't or the business can't afford to pay. Point 3, there is overdependence on the owner. And the subsequent points help me explain that. So illness or death may close the business. So the entire business is dependent on the health and the knowledge and the abilities of the owner. So if the owner is sick, what it means is that the business is actually sick. All right. They might not be able to open the business for it to engage in any meaningful transaction with their clients and customers. Okay. The illness or death, if there is death, what it means is that the business also must shut down because the owner is no more. This is what I was talking about when I spoke about limited capital. Okay, for investors and for financial institutions, this is a big deterrent for them. It's dangerous for them to loan money to an institution which can die. All right. If the business can die, what it means is that your capital or the money that you have invested will go bad. And so they are very careful when giving out financial assistance to sole proprietorship type of businesses. Okay. The investors won't usually invest in the business. I think we've explained that. Then there's problem of continuity. Once the owner dies, that really is the end of the business. And that is not something that is very good. Owners may be tempted to work for long hours, and that can be detrimental to their health. Okay, so under the advantage, we realize that it is the owner who enjoys all the profits. As much as that is good, the disadvantage is that you may be tempted to work longer hours, because you know that if the business was to be profitable, all of those profits or money come to you. All right. So there will be a lot of passion and zeal to work hard. At the end of the day, it could have a negative effect on your health. All right. If it was a partnership, there could be a day that you'll be off to take some rest whilst your other partner takes over in the day-to-day administration of the company, of the business. If it's a company, you may not even be part of the management of the business at all. And that gives you room to be able to rest and improve upon your health. So that is another point we have to take note if we choose the path of sole proprietorship. The desire to make more money, the desire to be successful could drive you to the point where you could be sacrificing your very health, okay, for money or for wealth. And we have to pay attention to that. Then we have the second form of business within the context of the public sector, which is partnership. All right. In explaining sole proprietorship, I've always come to this idea of partnership. So partnership is an association of two or more persons to carry on business jointly for the purpose of making profits. It is often termed as a firm. A firm refers to a body corporate registered by the Partnership Act 152. So this is within the context of Ghana. Okay. So two or more persons coming together to jointly run a firm or a business with the aim of making profit is what is known as a partnership. So I think it's coming from our everyday knowledge of the word partnership. To partner with somebody basically means you come together to work on a particular assignment or task in order to achieve a particular result. In the context of a business, it is the two or more of you coming together to run a business in order to share the profits that may accrue from that. Okay, so in Ghana, it is governed by the Incorporated Private Partnership Act 1962 at 152. It is not taxed separately from the owners. It has minimum of 2 owners to a maximum of 20. So even with partnership, there is some limitation. So you can't have beyond 20 partners forming a business. The maximum you can have is 20 partners. All right. It has unlimited liability. So just as sole proprietorship, if you get into partnership and there is liability, the personal assets of the partners can be sold in order to defray the debts of the partnership. However, we have to know that there is a form of partnership which is known as limited partner. So if one of the partners opt to that option to become a limited partner, then they almost enjoy the right as if they were shareholders. Okay, with a limited partner, their liability will be limited to only the amount that they have contributed to the partnership. But generally, partnerships do not have unlimited liability. They have the same traits like sole proprietorship, where the partners' assets could be sold in order to settle the liabilities of the company. Okay. Its profits and losses are shared equally, but this also is subject to the partnership deed that may be available to the partners. But generally, the reason or the way to share the profits of partnership is to share them, or the losses to share these losses and profits equally among the partners. Okay. Advantages of partnership. And to be able to understand all of these advantages and disadvantages, you must be comparing one form of business to the other. Okay, so if you talk about partnerships, in terms of point one, fewer regulations. This is an advantage when partnerships are compared with companies. Okay, so there are more regulations that and rules and laws that need to be complied with if you want to set up a company compared with setting up a partnership. However, if you were to compare partnership with sole proprietorship, you may come to realize that partnership form of business also require more regulations if you were to compare that to sole proprietorship. Okay, so to better understand this, we always have to compare the various forms of businesses to get a better understanding of disadvantages and advantages and disadvantages. Okay. Then there is wider degree of expertise. So to be able to explain this as an advantage, we need to compare partnership form of business to sole proprietorship. As we said earlier, with sole proprietor is just one person. Okay, so the expertise that are available to the company is limited to what the owner of the business knows. Okay, well, the knowledge base of the business owner really is what is available to the business. So if the owner is grounded in marketing, then the company will have knowledge and a lot of expertise in the area of marketing. If the owner is an accountant, that is likely what is going to happen. If the owner has expertise in IT, whatever field it is, okay, with sole proprietorship, the business is limited to that. If you come to partnership and you have, say, 20 partners, and all of these partners have knowledge in various functional areas of business, then all things being equal, a partnership is likely to have wider expertise available to it than sole proprietorship. All right. The next point goes similarly. We can explain in a similar fashion. There is shared responsibilities and resources. All right. So it's not just one person. So the issues about health and all that will be addressed with this particular point. One person is not responsible for everything. They are partners. Somebody might be good with keeping of accounts. Another is good with marketing. One is good with law. The other is good with IT. All of these resources, this expertise and knowledge can help, and that will help them to be able to share the responsibilities of the company instead of just one person handling all of these responsibilities. Okay. There is also flexibility. So it's coming from the varied expertise and knowledge that is available. There's no fixation. All right. If you were trained only as an accountant, there's the tendency for you to see everything from the lens of accounting. If you were a lawyer, there is a tendency to look at everything from the perspective of the law. But if you have people with varied expertise coming on board in the formation of a partnership, it gives room for flexibility in terms of thinking and decision making. Okay. Point 5, relative increase in the amount of capital. So if it is sole proprietorship, as we've explained, the capital available to the business, all things being equal, will be limited to the amount of capital that the owner has brought or will be able to raise. Okay, but if it is partnership, then you have more people coming together, and more people means more capital coming on board in order to run the business effectively. Okay, but there are also disadvantages with partnership. Once again, we have to be comparing partnership with sole proprietorship or companies to be able to appreciate these disadvantages. So point 1 is that there is unlimited liability. If we're to compare that with a company, companies have limited liability. If there is any crisis, your liability as a shareholder will be limited to the amount that you've invested by way of share acquisition in that particular company. But with partnership, except for limited partners, your private assets and property can be sold to defray the debts and liabilities of the partnership business. Okay. Then there could be problems of continuity. Once again, even though if you compare it to sole proprietorship, there is a better chance for continuity than that of sole proprietorship. If you were then to compare partnership with company, you realize that when it comes to continuity, companies are more better positioned to guarantee continuity compared with partnership. All right. So maximum 20 persons coming together. What it means is that if there is any accident, unfortunate accident, it is possible that all these 20 people can die at a particular point in time, and that will be the end of the partnership. And take note that even though the maximum is 20, most partnerships will not have that number. Most times there will be either 2, 4, 5 people coming together to form partnerships. Okay, if all these 2 people were to go, some disaster was to happen, what it means is that will be the end of that particular partnership business. All right. Compared with a company where there's a separation between management and the ownership of the company. Okay, and the company is deemed to be in perpetual existence. The death of even management team doesn't affect the company in any way. The death of shareholders will not affect the company in a way. So companies tend to have continuity. All right. Limited source of capital. Once again, this point is coming because we want to compare partnerships with companies. Okay, there is higher tendency or higher chance for companies to be able to access loans compared with partnership. Once again, it's because of things like the size, it's because of how these companies are managed, their structures that they have in place, the transparency and accountability that are associated with companies gives them a better chance to be able to raise more money compared with partnership. All right. So that is the other reason why this will be a disadvantage for partnerships. Okay. Point 4 says reaching a joint decision can be difficult. Yes. So this was an advantage we found in sole proprietorship. The owners basically can decide and implement their decisions quite easily. But if it is a partnership, as the name suggests, you need the consent and the opinions of your other partners before making a decision. And that could be difficult depending upon the type of partners that you have. Okay. Sometimes it's not because the partners are difficult, but if they feel the decision is not right, they will want to make their case as clearer and as cogent as much as they can. All right. So change in expectation may lead to the split up of the business. So that is that. Once it's a partnership, there is the tendency 2 or more people working together. Conflicts are likely to come up, and that could cause some partners to want to leave. Sometimes some businesses, partnership businesses, are not able to survive such conflicts and wranglings in that type of business. Okay, it could be the end of the partnership business altogether. Other times, it is probably the company will be suffering with issues of either funding or expertise. Okay, assuming the partner who wants to leave because his or her expectations are not being met is a major contributor in terms of the capital contribution to the partnership, or he was deemed to be the most knowledgeable person in terms of expertise. That can be a major problem for the partnership business. Okay. Then the last point is that each partner is bound by contracts of others, and this can really, really be dangerous, right? So once you are into that partnership business, what it means is that you've almost given your right to your other partners to be able to make decisions on your behalf. Okay, so there is the concept of vicarious liability where you can still be held liable, even though you were not the one that took decision in the partnership. All right. So if it's not even direct contraction of loans and it is a bad decision of a business, what it means is that if the business is running at a loss obviously you will be affected because you will not earn any profit. Okay, so the decisions of your other partners, if they don't make intelligent, wise decisions, you are likely to suffer as a partner in a partnership business. Okay, so let's look at companies. A company is an institution that is granted a right, recognizing it as a separate legal entity, having its own privileges and liabilities distinct from its members. All right. So a company is recognized in law to be a separate entity. It has its own privileges and it has its own liabilities. All right. So the members or the people that have come together to form the company are not the same as the company. The company is deemed to be separate and distinct from the people that came together to put their resources to form that particular company. Let's take note of that because that is a key attribute or feature of a company, okay? The concept of separate legal entity. All right. So in Ghana, the right to form a company, any one or more persons may form an incorporated company by complying with this act in respect of registration. So if you go to Section 6 of Act 992, it clearly indicates that even though a company will have connoted the idea of more people coming together, in Ghana, it is possible for one person to form a company. Okay. However, at any point in time, they may have at least two directors who will run the business of that particular company. So even though one person can form or register a company, at any point in time, it is required that we should have at least two directors to run the affairs of the company. Okay, but it is possible in Ghana to have one person forming a company. Section 7, subsection 1 of Act 992 provides us with the following types of companies. So we have a company limited by shares. We have a company limited by guarantee. We have an unlimited company. Then we have a new one that was introduced different from Act 179, which is an external company. Okay. A company of the type specified in subsection 1 may be a private company or a public company. So any of these ones, the companies that we've listed above could either fall under private or public company. Okay, so we can have a private company limited by share, and we can have a public company limited by share. All right. We can have a private company limited by guarantee, then we can have a public company limited by guarantee, and so on and so forth. So any of this could either be private or public company. So in effect, if we have 4 above, what it means is that we could have 8 types of companies in Ghana. If you look at the idea of the fact that they could either be private or public, that will give us about 8 types of companies in Ghana. So let's look at what they mean. So a company limited by shares is a company which has the liability of its members limited to the amount unpaid on the shares respectively held by them. So what this definition is basically trying to say is that if the company is in debts and is liable for the payment of some debt obligations, what the shareholders will basically lose if you have paid for all the shares that you currently own is that you will lose that amount of money that you've invested in that particular company. Okay. There could also be instances where you have some shares with you, but you've not yet honored or paid for the shares that you currently own as the shareholder of that particular company. In that case, you'll be required to pay for the amount of shares that you have held, that you hold, and have not yet paid for the shares that you own. Okay, so your obligations generally will be limited to the amount of shares that you own in that particular company. If you have paid for all the shares that currently you own, you only lose the amount that you use in buying or acquiring the shares of that particular company. All right. If you own some shares and you've not paid for all at the time that the company went into debt or is liable to another creditor, you'll be required to pay for the amount of shares that you own that you've not yet paid in terms of the share prices for the shares that you own. All right. So basically, that is the extent to which your liability will be limited or restricted. Okay, they cannot go to the extent of selling your personal assets or property to defray the debts or liabilities of the company. Okay, the next type of company is a company limited by guarantee. So a company limited by guarantee is a company which has the liability of its members limited to an amount that the members may respectively undertake to contribute to the assets of the company in the event of its being worn up. Okay, so the idea with companies limited by guarantee is coming from the word guarantee. All right, the members that form this company undertake to contribute certain amounts of money. They pledge on their own volition. If the company was going to be worn up, how much am I prepared to contribute in settling the debts or the liability of that particular company? Okay, so the amount that you undertook to pay is what you'll be liable to pay. All right, and you have to take note that at the point of making that promise is voluntary. You decide how much you want to actually contribute in case that particular company is worn up. All right. Then we have the unlimited company. So generally, though, the traits of companies are that they have limited liability for their members, there is also a form of company known as unlimited company. Okay. Currently, there is no example of such company in Ghana. All right. But unlimited company is a company which does not have a limit on the liability of its members. So it's almost like a sole proprietorship or a partnership type of business. So unlike company limited by shares, where members' liability will be limited to the shares that they have acquired, if you choose to set up an unlimited liability company, you will not receive any protection. Okay. Your personal assets and property can be sold in order to settle the liabilities or the debts of a company. All right. Then we have an external company. So an external company is a body corporate formed outside of the Republic of Ghana, which has an established place of business in the country. So we have companies currently in Ghana that they don't really have their business setup or establishment in Ghana. The company is probably registered in South Africa, but they basically have an agency in Ghana to be able to transact on behalf of the company that is set up in, say, South Africa or UK or any other country, right? So that type of company is what is known as an external company. So features of a company: it is regulated by Act 992. That is the new law that regulates companies in Ghana. It is owned by shareholders or members. So this is a general kind of statement, but if you go into company law properly or legally, a company is not owned by shareholders or even the members that came together to form it. All right. But in everyday explanation of ownership is used advisedly here. The shareholders came together or the members came together to form the company. So we can say in quotes that they actually own the company. But in law, companies are not owned by their shareholders. All right. So the third point seeks to explain that idea. It is a separate legal entity. So the company is distinct and separate from the shareholders or the members that came together to form it. Okay. It is registered with the registrar of companies. It must have at least one member. It is managed and controlled by a board of directors. That is also very, very important. Okay. Unlike the previous ones where the owners of the business, if you take Sole proprietorship is the owner that actually goes into the management. If you take partnership, it is the partners that will be in charge of the management of the company. But if you look at companies, okay, in partnership of the management of the business, but in the case of companies, you'll normally have the board of directors that will take the place of the shareholders or members of the company. They have to determine the long-term direction and vision of the company, set policies, then employ or recruit top-level management and guide their operations, and not day to day. From time to time, they will guide the operations of management in order to ensure that the vision of the company is achieved. Okay, so the management may not be the right word, but the oversight responsibility of making sure that a company is properly run is normally in the hands of board of directors and not the owners or the members or shareholders of that particular company. Later, I think we'll be talking more about board of directors, right? Then the other attribute of companies is that they have perpetual existence. Okay, so the death of member or even all of the members does not spell the doom of the company, because as we've just seen, there is a separation between the membership or the ownership and the management of the company. Okay, so if members are not there or if they die, the management of the company keeps on running. Okay, and the management, we even have two layers. We have the board of directors that are there to supervise the activities of the management of the company. So not even the death of a management or even a board member can lead to the death of the company. So if you see how companies are managed or structured, they have what is actually known as the perpetual existence. The death of one member or two members or three will not influence the company in any way. All right. So when we explain the types of companies, we realize that those four types of companies could either be private or public companies. I indicated much earlier that means then that we have 8 types of companies, okay? If you were to group them either as private or public, the 4 that we saw becomes 8. All right, so it is important for us to know the meaning of a private company. Once we understand that, then we can know all other companies that do not have those attributes can be classified as public companies. Okay. So the Companies Code 2019 defines private company as one which, and its regulations, 1, restricts the right to transfer its shares, if any. So for a private company, if they have shares, the right to transfer the share is restricted. Okay, unlike a public, if it is a public company, all that you have to do is to look for a broker on a stock exchange or stock exchange markets for the broker to sell your shares for you. Okay, we have Ghana Stock Exchange, whichever jurisdiction, Johannesburg or any other country that you find, New York Stock Exchange or any other country that you find yourself. All right, you can just get a broker to be able to sell your shares for you. All right, but that is not the case of a private company. There is restriction. You may have to get the consent of the other members of the company before you can actually transfer your shares to another person. All right. The other attribute of a private company is that it limits the total number of its members and debenture holders to 50, excluding people in proper employment who are members or ex-employees who were and continue to be members. So if it is a private company, the total membership, don't forget when we were explaining partnership, we said the maximum was 20, right? So if you set up a company and you also want it to be a private company, the maximum members that you can have is 50. And this includes the debenture holders of the company. So the debenture holders normally do not they are not shareholders, okay? They don't own shares of the company. Debentures are more or less debts that the company owes, and the company is supposed to pay interest, whether the company makes profit or not, all right? Some of these debentures are secured, and you must pay whether you are profitable or not. Otherwise, the debenture holders can sell those assets to defray or settle any debts that the company owes them, okay? But in defining the membership, they take into cognizance both those who own shares and those that have contributed to the company by way of debt or debentures. And all of that must add up to 50, okay? But in counting the 50, they'll exclude people, employees or ex-employees, all right, who are still members of the company. So if you're an employee or ex-employee of the company and you own shares, if you were even 100 in this particular category, when counting the membership of the company, this category of persons are excluded, okay? But whatever be the case, there is some limitation in terms of the membership to 50, okay? The other attributes of private companies is that it prohibits the company from making invitation to the public to acquire any shares or debentures of the company, all right? So that is the main thing about attribute or trait of private company. If it is private, the shares will normally be contributed by some number of persons, as you've seen in the earlier point. And so the company cannot just go out there and be inviting the public to come and invest in that particular company, okay? They cannot also just be asking for debenture holders to come and invest in that particular company. This provision is there to protect the general public, all right? If you look at public companies, normally they go through several checks and balances. The obvious one is the auditing and the publication of their financial statement. That is not the case of private companies. They don't have that kind of obligation. They may have it for their members, but not to the general public. So the general public don't get to see what is happening if a company is a private company. If that is the case, then they must also be protected. The public must be protected from investing in a company whose activities are actually opaque to them. Okay, so they are prohibited from inviting the public to acquire any shares or debentures from this particular company. Okay, the next point is similar to that, prohibits the company from making an invitation to the public to deposit money for fixed periods or payable at call, whether bearing interest or not, all right? So financial institutions like savings and loans, banks, and other non-financial institutions that are regulated may have different kind of rules applicable to them when it comes to this particular point. But generally, if you're a private company, you are not allowed to invite the public to make deposit, whether you be paying interest or not. Okay, so any company that doesn't have these attributes can be seen or classified as a public company. All right. So generally, public companies, it has its shares traded on the floor of the stock exchange. All right. Your stock exchange, various countries have that. It has a minimum of 7 members, and there is no restriction on the maximum number. Okay. So as many people as possible, subject to the amount of shares that has been floated, can acquire shares in a public company. Then it is required to publish its statement of financial position or financial statements annually. And this is very, very important. This explains why other restrictions may be placed in a private company where members of the public may not have access to the financial performance of these companies. Okay. And talking about companies, I think we've hinted on this. One of the major features is that they are normally controlled or directed by board of directors and not the owners of the company or the partners of the business. All right. So the board of directors are persons appointed to direct and administer the business of the company. They are elected by the shareholders of the company. Okay, so it's important for me to explain this structure very well. We're saying that when it comes to companies, Normally, the shareholders, who loosely may be referred to as the owners of the company, are not the same guys that will be managing the affairs of the company. So they need people that will represent them when it comes to the management of the company. Okay, so they'll elect a body known as board of directors. So these are people that are normally competent, qualified, and have a lot of business experiences to be able to tell whether a company is being managed well or not. Okay, but it's important for us to note also that the board of directors are also different from the management of the company. The board of directors, when they are formed, will normally then appoint what we call the top management of the company. Some of the key positions like the CEO, COO, auditors, whatever. Some companies have, say, finance officer or audits officer, or some top positions must actually be appointed by the board of directors. Okay, they will then in turn employ the other employees of the company. So it's the management that will be responsible for the day-to-day management of the business, but they are supervised and directed by the board of directors, who are supposed to be the representatives of the shareholders of the company. Okay, this is coming from the concept of corporate governance, or the idea of corporate governance. To make sure that these companies are properly governed, you need somebody to regulate the affairs of the management of the company. Don't forget, management did not put in any money. And so if you don't have anybody or group to supervise the activities, it is very likely that they will abuse or misuse the resources of the company. Okay, so in place of the shareholders that may not even have knowledge in business, whatever, they would then appoint or elect group of persons known as board of directors to oversee the activities of the management of the company. Okay. So what are the functions of the board of directors? They set corporate strategy, overall direction, mission, and vision of the company. Okay, so they determine the mission, the vision, and the overall strategy that the company will be pursuing. All right, so they are needed in companies. They are responsible for hiring and firing CEO and top management. When it comes to the top management, you need the board's approval before they can be appointed. In fact, they are interviewed by the board. The search even begins with the board in order to get top management of a company. Okay, so they are responsible for controlling, monitoring, and supervising top management. That is also important, because the shareholders that are supposed to be the owners will not normally be allowed to be part of the day-to-day operations of the company. Okay, if no matter the amount of shares that you hold, you can't just come to the company and ask to talk with the CEO or the COO because you are a shareholder. All right, if you are not fortunate, they may call security and you'll be arrested. All right, so owners or members of the company do not get themselves involved with the day-to-day management. They rely on the board of directors to control, monitor, and supervise the activities of the management of the company. Okay, board of directors are responsible for reviewing and approving use of resources. So if there is any major expenditure, minor expenditure could be taken without board's approval. But if it is a major expenditure of a certain magnitude of or amount, most times those kinds of expenditure must get board's approval. All right. This also explains why when there is a problem, sometimes board of directors can be held liable instead of the management of the company. Because if things goes wrong, it simply means that the board did not exercise their oversight responsibility. They approved the use or misuse of the resources, and therefore they can't be held vicariously liable for such wastage. All right. Point 5, approving important financial decisions such as annual budget and reports to shareholders. So that is that. Before financial statements are presented to shareholders, they should have been approved by the board of directors before that is done. Okay. based on this explanation, what are some of the advantages of companies, and within, to be more specific, limited companies, because we said we have unlimited companies as well. Okay, so point one is that they tend to have relative more capital than partnership or sole proprietors. One is because they can float shares and get equity. Two could be that they tend to have better governance structures in place. So financial institutions tend to be more confident about the operations of these companies. Three is the issue about the fact that they have perpetual existence. So unlike partnership or sole proprietorship, where you'd be scared that the owners could die, and in a company, there is perpetuity, all right? So investors and financial institutions are not scared to loan them money, all right? 3 or 4 is the fact that they normally are required by law to prepare financial statements, and these financial statements can give some form of assurance as to the performance of the company when financial institutions or creditors want to grant them loans. Okay. 5 is that because of their size, they tend to have more assets or resources that they can use to serve as collateral when it comes to the acquisition of loans or debt generally. Okay, so there could be several reasons why limited companies or companies as a whole will be able to get more funding or capital than sole proprietorship and partnership type of business. Point 2 is that the company's name is protected by law. And in business, this cannot be treated lightly, all right? The fact that it is protected by law. Businesses invest in a lot in what is known as brand name or brand image, because largely what we buy, what we wear, what we eat are names. Okay, so names come with some image, some reputation in terms of quality, in terms of durability, in terms of efficiency, and all manner of things. So if you struggle to build a brand in terms of the quality of your product, if somebody was to steal that particular name, what it means is that all the investments that you've made in order to raise the image of your company is taken away from you. All right. That is not the case in terms of companies. Your name will be protected. As a matter of fact, there is all provisions in various acts on company names that must be fulfilled before a company can be named in a particular way. Okay, if they were to find that the name is similar to an existing company, it will not be registered. And if you also on your own decide to use a company's name without registration, a company that is already in existence without the proper registration, you can be taken on legally. Okay, so company names are important and they are protected by law, and that's very, very important. After all the investment to be known in a particular way, yeah, those investments will not go to waste because the laws of various lands will protect you. Shareholders have limited liability. I think we've explained this much earlier. Your liability will be limited to the shares that you have acquired in that particular company. Okay. There is greater specialization. Unlike partnerships or sole proprietorship, where the owners are limited in terms of their expertise and knowledge. In a company, companies can afford to employ people with varied expertise. So the management of the company are people with knowledge and expertise in various areas, and that also helps them to specialize. Okay, so we have people in the production department that focus on production. We have people in marketing department that focus in marketing. We have people in finance and accounting that focus in that area. We have people in legal department. We have IT. We have risk management. All manner of specializations in companies that are not normally available to sole proprietorship and partnership type of business. All right. The next point we've also explained is that it has perpetual existence. The death of a member of a company does not result in the death of the company. In fact, they might not know. The company and its management wouldn't know that a member has even died. Okay, if you're dealing with a very huge company or a public company, they won't even realize and feel the death of a member of the company. So there is perpetual existence when it comes to companies. It tends to enjoy economies of scale because of the sheer size of companies. They tend to do things in larger volumes and quantities than sole proprietorship. Okay, so when they are buying things, raw materials, they have the capacity to buy in larger quantities. That goes with some advantages, isn't it? Okay, they can enjoy discounts and they are able to even bargain for lower prices because they don't buy in smaller quantities. Okay, so the benefits that come as a result of producing higher quantities is what is termed as the economies of scale. When it comes to production, there could be more efficiency when you're producing in larger volumes than in smaller volumes. When it comes to even transporting things, it is cheaper when you're transporting in larger volumes than in smaller quantities and so on and so forth. Okay. But it is not all rosy for companies as well. They have their disadvantages. All right. The first one is that corporate activities are limited by its constitution, by the constitution of the company. Some jurisdictions, they may be called the regulations of the company. So the regulation is like the constitution of the company. That will spell out what the company stands for and what the company will be doing and so on and so forth. Okay, so most of the time in the constitution of the regulation, the objects and the details of what the company will be doing will be spelled out. And in some jurisdictions, to be illegal to go beyond what you say you'll be doing in your constitution or regulation. All right. Decision-making can be slow and red tape can be a problem. So there are structures, unlike sole proprietorship where you can just get up and do anything that you want. Companies are not like that. We've just learned that even for management to be able to take some decisions, they will need board approvals. Okay, so the board management must first go to the board and make their case argument why they want to make that decision. Then the board must deliberate and either agree or disagree with that particular type of decision by management. So you don't just get up and take decision. And that explaining that within the context of a disadvantage means that you won't be able to get some things done quickly as management as they may want it done compared with, say, sole proprietorship. All right. Accounting of companies are less private. So if it is a public company, especially, they are supposed to publish their accounts. The accounts must be audited. They must be published for the general public. So there is no privacy really when it comes to companies. There are a number of legal requirements to fulfill, which is expensive and cumbersome, right? So it is not as easy as a partnership or sole proprietorship. Okay. There is the lack of motivational spirit due to separation of management and ownership. When we're explaining sole proprietorship, we said the owners also are responsible for the management. And because they will be enjoying all the profit, they normally have a lot of zeal and passion, enthusiasm, and committing to performing the activities of the business. That is not the case of companies. So company, there's a separation between ownership and management. And so there is the tendency that management might just relax. After all, it's not their money, okay? Instead of working hard with passion and all that, they can choose to just relax and take things normal, all right? Because they are not really the owners of the company. This explains why when in the structure or governance of companies, you also need board of directors besides the members or shareholders of the company. It's the board of directors that somewhat will put pressure on the management of the company to work hard in order to fulfill the interest of the shareholders of a company. Okay. Otherwise, there is the tendency that some management of a company may not actually be working hard because they feel it is not their business. All right. They will feel it is not. All right. So let's look at reasons for choosing the right form of business ownership. Okay. If you want to operate in the private sector, we said you have the option of either going as a sole proprietor, in which case you'll just be the sole owner of the business. You have the option of going into partnership, where you can go partner with a maximum of 20 people to run the business, or you can opt for a company, in which case you even lose ownership of the company for management to run the company on your behalf. The only way you get to control, in quotes, the business is if you appoint competent board of director to replace you in directing management as to how the business should be run. Okay, so what are some of the reasons in choosing the right form? There are implications. Whether you go for sole proprietorship, partnership, or companies, there are consequences. Okay, so why is it important to know the right form? Whether to go for sole proprietorship, partnership, or companies. All right, point one reason is that how the businesses are organized is different. Okay, yes, the management and the governance structure in these companies are not the same. We just explained that. If it is a sole proprietor, you, the owner, will still be responsible for the management and the governance of the company. It has its advantages and disadvantages. All right, you may be knowledgeable or limited to just a few fields. If you don't have the expertise in other areas, your company may suffer, and so on and so forth. The health implications are things that we cannot overlook. But with a company, you don't have to be part of the management of the company. Okay, that also may have its disadvantage because it comes with third-party deficiencies where they may be taking decisions that are not in your interest. So you need to know about these distinctions, because how these companies are organized in terms of the management and governance structure are not the same. How cash flows are handled are not also the same. Okay, if it is sole proprietorship, you receive all the money, you have to go and deposit them in the bank, keep your own books of accounts. Literally, nobody comes to force you to see how things are done, except in cases of payment of tax, personal tax, and so on and so forth. Okay, and companies, there are proper structures in place in dealing with cash flows. You can't just use the money anyhow. All right, so how cash flows are handled becomes very, very important. So proprietors, if you are hungry, you can just take out some money and go and buy food and so on and so forth. That is not the case of companies. Okay, how the business is taxed differently. When we take sole proprietorship and partnerships, the money of the business or the income of the business is also seen to be the income of the partners or the sole proprietor. That is not the case of a company. What it means is that in sole proprietorship and partnership, the only tax they may be paying is personal tax. Okay, but when we come to companies, companies are normally subjected to what is known as double taxation. Okay, so there is a tax on the net profit of the company or on the profit of the company before the deductions are made to get your net profit. So there are tax on that. Then before even that, if the company chooses to declare dividends and pay dividends to shareholders, when shareholders are being paid out of the profits of the company, the shareholders are also taxed. Okay, so shareholders of the company will pay personal tax on the dividends that are paid to them, and the company after that will also be required to pay what is known as the corporate tax. All right, so depending upon the analysis of the company, they may either choose to pay more dividends in order to reduce their corporate tax, or if they choose not to pay more of dividends, they are likely to pay more corporate tax. But in whatever form, they are subject to these two types of tax. Personal tax will be paid by the shareholders on their dividend payments, and the company will also be required to pay corporate tax. Okay, but as we've seen in sole proprietorship and in partnerships, they are simply required to pay personal tax because there's no distinction between the owners and the businesses. All right. So that is the other thing we have to note. Then how the business is financed. I think we've explained a lot. In sole proprietorship and partnership, it's limited to the amount of funds that the business owners bring to board. Okay, and it's normally limited because of the disadvantages that we've explained much earlier on. They don't have, it's limited to just the number of business owners that come together. In the case of partnership, maximum of 20. In the case of sole proprietorship, it's normally just one person. All right. Because of issues about the size, about resources or assets, they tend to find it very difficult to be able to raise funds from financial institutions. But that is not the case of companies. Okay. Then the next point is we've explained that under how the company is organized. Okay. How the business is controlled and managed are different. So proprietorship and partnership, the owners are involved in the management. In fact, sometimes they manage and control the business, okay? Or most times they do that. That is not the case of company. Company, there's a distinction between management and ownership of the company. How profits are distributed. So the profits of the business in the case of sole proprietorship and partnership are the same as the monies for the owners of the business. Okay. So in partnership, they decide based on their partnership how they want to share their profits. Or generally, they may share this profit equally among themselves. And sole proprietorship, it is the sole proprietor that takes all of the profit. Okay. When it comes to companies, that is not the case. The board of directors and management must decide how much profit they want to retain and reinvest in the business and how much we pay to shareholders by way of dividends. Okay. So how profits are distributed are actually different in these various types of businesses, and that should guide you in terms of selecting the form of business that you want to operate in. All right. Then how liabilities and risks are dealt with. We said in sole proprietorship and partnership, there is no limit to your liability. That is very, very important point that you don't want to forget. There's no limit to your liability. In business, we don't just think about making money, but we also have to think about the liabilities or the consequences or the risks that may be coming up. All right. So, but in company, especially in limited company limited by shares, your liability will only be limited to the amount of shares that you've bought from a particular company. Okay. So this brings us to the end of our discussions on the forms of business organizations. We've been talking about sole proprietorship, we've been talking about partnership, and we've been talking about companies. All right. I hope this helps and guides you in your quest to set up a business and operate your business. Thank you for your attention.